Hello, everyone. Today on the Final Bar, featuring Tony Zhang from OptionsPlay, is going to share with you a couple charts that are top of mind for him. We have a choppy day for the financial markets, I would say overall. The S&P sort of a V-shaped performance today, down in the morning, back up and recovering for much of the afternoon. Mixed messages overall, with the cyclicals really weighing heavily on the market. Technology holding in just fine with defense at the top. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message of the markets themselves. We focus on the important messages of price and breadth and sentiment. As we've talked many times on the show, I would argue the goals for an investor should be three things. Number one, identify trends. Number two, follow those trends. Number three, understand or anticipate when those trends may be reversing. And what we've seen in terms of looking at the S&P over time is a resilient market, right? Crawling the wall of worry, if you will, or climbing the wall of worry, continuing to chip ever onward and ever upward. But overall, some concerning signs if you look a little deeper underneath the hood. The equal weighted S&P breaking down versus the cap weighted S&P. Only 55% of S&P names above their 50-day moving average. It's all not well, even though the indexes themselves seem to keep pushing higher. We're going to start looking at all of those breadth and sentiment readings this week. Today, we're going to start with a great breakdown in terms of price and what we're seeing. Now, we have some great guests on the show. I'm excited to talk to Tony Zhang from OptionsPlay here in a little bit. Coming up tomorrow on Wednesday the 7th, we have Pat Ceresna from Market Huddle. On Thursday, Mark Newton from Newton Advisors. Then coming up all next week, the week of July 12th, we have our special mid-year event called Charting the Second Half. Features expertise from people like Linda Raschke, Tony Dwyer from Canaccord Genuity, Gina Martin Adams from Bloomberg, and also some people you may be familiar with, guys like Martin Pring, John Murphy. I'll be sharing some comments from my conversation with them and many others. And then finally, we'll finish the week with a panel: Jay Woods from Drive Wealth, JC Peretz from All Star Charts, John Kosar from Asbury Research. It's going to be a fantastic week of investors, strategists, traders taking a step back, looking at what the first 6 months have brought and looking forward to the next 6 months of performance. Should be a lot of fun. So join us for sure all next week. I want to start our market recap by answering the poll question. We usually have a poll running on our StockCharts TV live stream, but also through social media. We asked you recently, know your technical indicators. Which of these would be considered a trailing stop indicator? We gave you four choices: parabolic systems, RSI, DMI, and ADX. Now, if you know your technical indicators, you know that all four of those were actually designed by the same gentleman, Wells Wilder, who really created a lot of technical indicators that many of us sort of take for granted. It was designed in the 1970s, pretty much looking at the commodities market and trying to understand turning points in those. RSI is more of a momentum indicator, more of an oscillator. DMI and the ADX are really measures of trend, which means parabolic systems, which 56% of you correctly answers, is absolutely right. It's really a systematic way of applying a trailing stop pattern. It's based on the range of the asset that you're looking at, and basically has a series of calculations to track an uptrend and track a downtrend, keep you in an uptrend as long as it's in play, and get you out of things when it starts to not work. So well done, 56% of Final Bar Nation for correctly answering parabolic systems. If you're not familiar with any of those indicators, by the way, I would go to our Chart School portion of the website where we have a lot of great educational material for you. Now let's continue on with our market recap. As I mentioned, it's sort of a V-shaped day. So if you can look at the two-day preview chart, you can see the strength going into the long holiday weekend. The Friday before a long weekend is most often a little lighter volume, most often flat to positive. And last week really did not disappoint with sort of all of those things, finishing in a position of strength, arguably accelerating into Friday's close. Today, we sort of gave a lot of that back and more in the first half of the day before recovering about 2/3 of the way back up, closing just below 43.45. The noteworthy movements elsewhere, the Dow actually down 0.6%, the NASDAQ 100 up 0.4%. We've talked about Dow theory, and if you look at a chart of the Dow Industrials and the Dow Transports, Charles Dow's original, or close to his original estimation of Dow theory using different parts of the economy, they're both sort of in negative mode. Over the last month, they've actually given a Dow theory sell signal, depending on how you calculate them. If you look at the S&P and the NASDAQ, however, no sell signals anywhere. It's still overall in an uptrend. Continued weakness from mid caps and especially from small caps today, down almost 1.5%. And if you look at the sectors that were weaker today, energy, financials, industrials, materials, those sectors overall are a little more common in the small cap index than they are in the large cap index. So understandable that you see further weakness in small caps, and the VIX is around 1640. Looking at other asset classes, I would say the breakdown in the 10-year is a key story we'll be hitting on a lot this week. If you look at the chart of the TNX, which we'll jump to here momentarily, we can see the fact that rates have been going lower is not a new phenomenon. Once we rallied into the peak in March, we saw this bearish divergence of higher rates where the 10-year peaked around 175 in mid-March, and lower momentum. And it's called a bearish momentum divergence. If you flip this chart upside down, it's essentially a chart of the AG or the TLT, where you saw the sell-off in bonds and a bullish momentum divergence with the price going lower and the momentum actually going higher. From there, that's been the peak in the 10-year, retested that at the end of March. And since then has really put in a fairly consistent pattern of lower highs and lower lows, now below the 50-day moving average, remaining below there. And now the 10-year's down to around 137. That down move in rates, that breakout in bond prices, again, if you look at the AG or the TLT, is what is one of the things that is certainly providing a tailwind to growth stocks, things like Facebook and Amazon and others that are having pretty decent rallies right about now. And also a headwind to things like financials. It's with this line and with this chart going lower, it's hard to expect, or it'd be difficult to expect, a raging outperformance from the financial sector, given that this is pretty much the opposite of what you would want to see owning a bank in terms of your ability to make money as a bank, to be honest with you. Looking elsewhere very quickly, the dollar was actually up about 1/3%, and that stronger dollar environment is certainly affecting global stocks. If you look at U.S. versus non-U.S., continuing to favor U.S. stocks, and as long as you keep seeing a stronger dollar, that's reasonable to expect further move there. Commodities overall actually weaker today. You saw energy was the worst sector of the 11 today. Oil price is down. The USO was down just over 2%. The only commodity out of the major 8 that we are tracking here using ETFs is the GLD, which is up 0.5%. It's a fairly interesting pattern on the GLD. I know Tony and I are going to talk about gold in a little bit, so I'll save any additional comments on there. But certainly commodities have been in a long-term uptrend, giving some of that back. But gold in particular starting to rally. Cryptocurrencies overall, as always, relatively volatile. Bitcoin up 0.6%. Ethereum really one of the largest gainers, up about just over 5% today. When we're looking at sector returns, thinking about the movements today, it's interesting to see real estate and utilities, two of the most defensive sectors, arguably at the top of the return list. We've talked about the relative performance of real estate for quite a while, and that if you look at the relative strength on the real estate index, if we jump to the XLRE here, you look at the difference between 2020 and 2021. I'm often asked about relative strength and why it's something to pay attention to. And a chart of the XLRE is probably a perfect example of that. Look at the difference from 2020 and a continued or a consistent run of underperformance by the real estate sector. And you'll notice if you didn't have the relative strength lineup, the chart itself doesn't look bad, right? I mean, it's not that real estate was breaking down on an absolute basis. It just wasn't going up, and certainly not going up as much as other sectors are out there. And that's where the downtrend in relative strength really shows you the opportunity cost, really, right? I mean, if you're owning XLRE, you're choosing not to own other ETFs out there. And that line going down is showing you how it's hurting your relative performance. Look at how that changed starting in mid-January of this year, and overall has been a fairly consistent string of outperformance. So looking at those relative strength lines, looking at things like the scooter rankings to see what's improving, to see what's breaking out on a relative basis, can be a really helpful way to focus on the particular chart you should be looking at. And what's interesting, zooming in on the chart of the XLRE, is you have this sort of stepwise motion in the last 6 months or so, really year to date. We can see the higher low in May around 41 on the XLRE. Now another higher low around 44. The rally today potentially making this look like another sort of pullback before the next move higher. So I think you pay attention to the highs from earlier in June, see if we're able to continue and push that trend further to the upside. Elsewhere in a market recap, things that were underperforming today: energy, financials, materials, industrials, the cyclicals. That's not a new theme. We've talked about the relative weakness in some of those sectors. Energy really got crushed today. And some of the stocks that I was looking at earlier, things like FANG, which have been, last week, a couple trading days ago, is testing 100, a big round number. It's starting to break above previous resistance in March. It looks like a beautiful setup for potential further upside. Again, today is one day, but down 7%. Is putting it back a little bit off of those highs. It's interesting how that's pulled back right off of a big round number of 100, which more often than not just tends to be a consistent level you want to pay attention to. Anything hitting 100, 1,000, $10, and so forth. At this point, it'll be interesting with a lot of these energy stocks. They don't all look exactly like FANG, but the 50-day moving average for many of them is below where we're at right now. Paying attention to where some of these leadership stocks have been, if and when they pull back, seeing if they're able to hold that ascending 50-day moving average could be an important line to pay attention to. We need to take a quick commercial break. We'll be back with my guest, Tony Zhang from OptionsPlay. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. As a reminder, we love to hear from you. We're going to do another mailbag segment a little later in today's show. We would love to hear your questions as you're analyzing your own charts of interest. Our email is thefinalbar@stockcharts.com. You can look us up on Twitter @FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching. We would love to hear from you. Questions that are coming up as you're analyzing your own charts, things you're hearing elsewhere in the media from other analysts. Let us know how we can help point you in the right direction using the power of data visualization and the power of stock charts. Also, as a reminder, go to StockChartsTV.com, use your email account, set up a free account on the website, and you'll be able to start watching all of our great content on demand on our website, also on all of your mobile devices. Just look on any app store for StockCharts TV on demand. I want to welcome on today's guest, Tony Zhang. Tony's the founder of OptionsPlay, based in New York. Does a fantastic job, in my opinion, of making options, which for many can be somewhat of a confusing area of the market, very accessible. And we're excited to get his take on the markets right now. Tony, welcome back to the show.
Thank you so much for having me back, David. Looking forward to talking some charts.
So as we were talking in the market recap, Tony, gold and commodities overall have been an area of focus for a lot of investors, just seeing that theme emerge, but many of them have pulled back a little bit. Gold overall had an incredible run going into May, early June. Given some of it back, what are you seeing with gold now?
Yeah, so as you said, with a lot of commodities pulling back here over the past couple of months, we've seen a bit of a resurgence into some of these commodities. Granted, today has been a fairly weak day across the board for commodities, but like you said, gold is holding in there. For me, I think the big level to pay attention to here for gold is that 166 level. If you look at a long-term chart, it almost looks a bit like an inverted head and shoulders that's forming here at the 166 level, being that shoulder level, and the inverted head and shoulder, or inverted head, around 157 or so. We're seeing a bit of capitulation here to the downside, holding that 166 level. So I'm looking for this potential revisit back to that 200-day moving average around 169, 170 or so. If we can clear that 169, 170, 200-day moving average, that's really where I think we're headed back to that 178 high that we put in recently back in late May, early June or so. I think along with commodities where I expect a bit of upside, I think gold is likely going to see holding the support here.
And it's interesting how the momentum has totally come out of the gold trade. You have the MACD at the bottom, right? Sort of a measure of trend. and it looks like it's starting to hook higher. How important is a buy signal from something like MACD as part of the thesis, or is it more about price levels when you're looking at something like this?
So for me, I always look at price levels first. My thesis is always going to be based off price action, and then I could use a MACD as a confirmation of that support level holding, but I rarely would ever use a MACD as my sole decision-making process. I certainly would not use MACD as my reason to go out and buy a particular asset. I think price action is far more important. And the fact that we're holding this 166 level is that important price action that confirms what looks like a bit of a bottoming formation being completed with this inverted head and shoulders. And if you could see that MACD also, as you say, hooking higher and starting to cross into that buy signal, that's really where you have that better confirmation and more confidence in looking for further upside in gold.
It's a great take in gold. Chart number 2 is MHK Mohawk. This is a group within consumer discretionary. It's had a nice run just in the last couple of weeks or so. Talk us through this chart.
Yeah, exactly. So Mohawk is really one of these names within the home construction index that a lot of investors don't pay a lot of attention into. I tend to find there are a lot of industrial names and material names that are not household names that we don't think about very much, but it is one of the largest makers of flooring and carpet. And it has pulled back quite a bit, especially relative to the home builder index. Home builder index down about 10%, this stock down about 23% over the past couple of months. And that's really the opportunity that I see. I think it's oversold a little bit too much relative to the primary index that it trades within. And technically speaking, it did pull back to that 150-day moving average, which I do think is important, and especially bouncing off that 175, 178 level here or so. And the fact that it cleared back above the 21-day moving average, for me, confirms that the pullback is complete and that we're starting to continue on that bullish pattern, which, as you can see, over the past, since pretty much July of last year, we've seen this continuation higher here. The pullback completes that pullback. The break above the 21-day moving average is confirmation that this is resuming its bullish trend. It did test the 21-day moving average today, but I do believe the close today did manage to close just above that 21-day moving average.
It's a great chart to watch, Tony. Just with the minute that we have left, I'd love to just ask you about the broad market environment. We have the S&P that continues to move to all-time highs today, giving some of that back, but not nearly as much as it felt like we would earlier in the day. You know, overall, when you're thinking about where the S&P, where the equity markets are in the seasonally weakest part of the year, but with some of the growth areas continuing to expand, what are you looking for in the next couple weeks, the next couple months, as you make sense of this trend?
So I think that at this point, you know, you mentioned a couple of things. The market breadth here is really concerning to me. The fact that the S&P and the NASDAQ continue to melt higher, but across the board, we see the Dow, the small caps, the equal weight indices no longer confirming those new highs. Those are concerns for me. So I think this is the type of environment where I would prefer taking profits, selling cover calls, and being prepared for a potential pullback, a more violent, a more quicker sell-off. And I would use options as my way to potentially protect myself a little bit to the downside, especially as volatility, as you say, VIX is at pre-pandemic levels here. Buying some protection is actually a little cheaper at the very moment. So thinking about buying some protection and preparing for that, because I do think as this continues to melt up a little further, you could see a more violent pullback.
Tony, really appreciate your thoughts as always. Thanks so much for joining us. Stay safe, travel safe, and we'll talk to you again soon.
Thank you so much for having me, David.
It's Tony Zhang. Tony's the founder of OptionsPlay based in New York. I loved his take, and I promise I did not feed him the answer to my question, but I loved how when I asked him about MACD, he mentioned an important word, which is confirmation, which is the way we've described a lot of those technical indicators on this show. I think a lot of people, especially when they're just starting to get comfortable with technical indicators and technical analysis, they think of it as a series of indicators. And I've seen some of the charts that people refer to. They are very, very busy. If you look at the charts that Tony was sharing, they look very similar to the types of charts we share on the show, which are relatively straightforward. They're relatively simple, and they're meant to capture trend and strengthen those trends and reversals in those trends. And I think thinking of the message of price primarily and then looking for confirmation elsewhere is there's a lot of wisdom in those comments. Great take from Tony, and appreciate it very much. Let's continue on with our next segment, which is the final bar mailbag. We always love hearing from you, questions that you're running into as you focus on your own charts. We very much appreciate it if you email us at thefinalbar@stockcharts.com as questions come up. Let's get to the final bar mailbag right now. Question number 1. There we go. Let's see. Many of the stock charts, this is a timely question. Many of the stock charts experts use either MACD, PMO, or PPO crossovers in a variety of ways. I skimmed through Jackie Ann Patterson's Truth About MACD. It seems only MACD crossovers below the zero line were considered useful, and she found non-divergence elements of the MACD, including MACD lines crossing or MACD histogram upticks, did not fare well in backtesting. Any general rules for the most useful ways to use the MACD or PMO? It's a really good question, and I'm not familiar with Jackie Ann Patterson, the book or the article that you mentioned. I am very familiar with MACD and PPO and the other indicators that you mentioned. And you're absolutely right. I mean, one of the ways that people do tend to think of that, and I'll bring up a chart here. I'll add the MACD on the bottom. Here we go. And the MACD and the PPO, as I'm bringing this up, to be honest with you, are really, you could use them interchangeably. Their calculations are a little different because the MACD is based on price and the PPO is based on percent move. So it's a little more of an apples to apples comparison if you're looking at a bunch of charts, but overall the signals are almost identical and you can use them interchangeably, to be honest with you. So the MACD indicator is basically looking at when we're crossing above or below. And in general, when the MACD line crosses up through the signal line, that's a buy signal. The most obvious one on the chart here is from March 2020. A sell signal is when you rally, and then the MACD line crosses down through the signal line like you did here in June of 2020, looking at the chart of Diamondback Energy. Your comment is, what is that, relative to the zero line, that's more or less effective? And you're absolutely right. I mean, in general, the ideal signal is it's well below the zero line and you have a buy signal. The ideal sell signal is you're well above the zero line and you have a sell signal. And those are the ideal signals. But I found with technical indicators, as with most investing, there are ideal signals and then there are the signals you normally face in the normal day-to-day, and they're never ideal. So what happens is this sort of environment, like you have December, January, February, March, where you get a bunch of little signals above the zero line. And what that tells you, those are not major trend turns or of any sort. They're just really tracking the short-term fluctuations up and down in the price. The real significant buy and sell signals are when they a sell signal far above the zero line, a buy signal far below, and that's absolutely right. If you looked at the chart that Tony Zhang shared earlier, by the way, with Mohawk, you saw how both of those charts sort of getting close to or at a little signal there, and again in the appropriate location. Next question, why does everyone seem to use the 50, 100, and 200-day moving averages? The short answer is because that's what everyone uses. And I'm sarcastically to a degree saying that, but most charting platforms that default to having moving averages, which they do, use the 50 and 200 days. In general, you can map that to about a quarter and about a year of trading, but that doesn't really map out. I mean, a year usually has about 260 some trading days. So it's, I've always thought of it as more of an estimation to that. I think in general, those were easier to calculate, big round numbers like that. And so that is what people most commonly use. I've seen people use like a 65-day, moving average to try and better estimate a quarter, but the 50-day is most commonly used. And a lot of trading systems use the 50-day or the 10-week moving averages as key measures. The 200-day is just so widely used. So investors I've worked with that manage large portfolios and are not technically oriented still seem to know when the stock is hitting the 200-day moving average. That's enough for me to believe that they're worth following a little more than other things. So that's why the 50 and 200-day in particular are the most common that I've seen. The 100-day is probably a little less than that. The 21-day, which you saw Tony use earlier, are maybe secondary to that as well. Next question, a lot of technical analysis methods are based on momentum. If markets are choppy, going sideways, or rotating rapidly, I'm frequently out of sync with the market. Do you measure or gauge this and how to respond? Smaller positions, don't use momentum, et cetera, et cetera. You got a lot more to that question. That's all I can get to today. Yeah, it's a really, really good question. So there are two things. Number one, you either have to recognize your toolkit is only going to be ideal in certain circumstances, and things like MACD and moving averages and others are actually known in a category of technical indicators called trend indicators. And they are meant to measure trends, which means when a market is trending, using moving averages will be incredibly helpful. If you have a choppy market, though, and boy, I wish I could come up with something. Maybe Intel is a good example of this. Yeah, it's not bad. So look at the chart of Intel and look at the 200-day moving average, right? How helpful is it to be buying when the stock breaks above its 200-day and selling when the stock gets below its 200-day using Intel? Not so helpful, because all you're doing is buying and selling within about a $3 range over the last couple of years, because it's really more range bound. Intel is not in a trending environment. It's in a big trading range over the last couple of years. So looking at the 200-day moving average is super not helpful. Looking at when the 50 and 200-day crosses is also incredibly not helpful as well, because it's giving you a sell signal here in August of 2020, a buy signal here in February of 2021, and you basically play the stock very, very poorly. So the challenge with a lot of indicators like that is they're not going to work in all environments. They're meant for a particular environment. So number one, you can either recognize that Intel is range bound, not be looking for a trend, but looking for mean reversion, and assume that this range will hold, and be thinking about selling in the 60s and buying in the 40s, and betting on that mean reversion trade to continue to play out. There are ways to try to make that a little more systematic, and we're out of time, but I would point you to something like the ADX line. This stands for average directional movement. And often what people will do is, if the ADX line is above 20 or 25, that is more of a trending market. If the ADX line is below 20, that is more of a range bound market. So using something like that, that is just a measure of trend strength. And it's not really telling you direction. It's just telling you strength of the trend, can be helpful. And so I've seen people design trading systems with the ADX telling you whether to be in trend following mode or mean reversion mode. For me, it's much more of a subjective exercise, and recognizing which charts are decent for trend following indicators and which ones you may want to avoid. The great thing for equity investors is, when something's not working, the best thing I would say is to get out of it. Justin Mamus, who's a famous technical analyst, wrote some fantastic books on the topic. Used to say, if you buy something and the stock doesn't do what you're expecting, then sell it. And I'm paraphrasing, but his argument is basically in your question, which was, do you just admit it's not your kind of market and go somewhere else? And that's what Justin Mamus would suggest. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the GLD. I thought Tony Zhang did a fantastic job earlier talking about gold and the potential move higher. One thing he didn't mention that I'm noticing is the bullish momentum divergence. If you look at the lows mid-June to late June and the RSI, that's sort of a bullish momentum divergence. We had a similar bullish momentum divergence from bond prices before they started rallying, continuing through the upward trend that we see now. So I think the chart of gold is fairly interesting to watch, actionable. Tony echoed that. I was talking with Greg Schnell last week, who also had his eyes on that bouncing gold. So I would certainly watch that one. Chart number two is the breakdown in yields, the rally in bonds. The stock to bond ratio has been favoring stocks for so long, we've forgotten what it looks like when it actually starts to favor bonds. It's actually happening when you have a nice rally in bonds like you did today and a bit of a sell-off in stocks. It's making that ratio roll downwards and favoring bonds. What we see with the chart of the TNX is that the RSI is now in bearish mode. It's below 60 on a rally. It's getting below 40 on a downtrend. And overall, I'm looking at 127, which would be the next Fibonacci support level based on the upward movement in yields in the top at the end of the first quarter. Finally, charts like Amazon tell you to remember that regardless of what you see elsewhere, a big base breakout is a big base breakout. This is a 10-month base. And what I mean by that is a range from high to low, a resistance level that's tested a number of times. As we've seen, Amazon as of today with a nice jump higher, breaking out of that base. That measures, I think, to around 4,200 or so when I was looking earlier, in the low mid 4,000s, if I remember right, based on the height of that pattern being echoed higher, and you see a potential further upward move in that chart. So breakouts on charts like this are always encouraging in any environment, but the strength like this in a mega cap stock like Amazon is certainly worth paying attention to. This is why the index won't sell off too much if stocks like Amazon and other names like Microsoft and others are holding up as well as they are. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Tony Zhang helping us with his view on gold and Mohawk today. As a reminder, get your questions to us. We'll do another mailbag segment at the end of this week. Our email is thefinalbar@stockcharts.com. We would love to hear from you. Also, go to stockchartstv.com, use your email, set up a free account, start watching all of our great content on demand. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Bryson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.